So with the world the way that it is right now, I thought I would put together a video where I show you how you can go about managing your stock portfolio and hedging out the market risk, because obviously very recently the stock markets around the world took a massive plunge, and with that obviously it would have scared a lot of investors. Many of them may have sold, got rid of their portfolios only to have seen the stock market recover. And what I want to do is show you a way where you don't need to go through that pain, so you can maintain your stock portfolio, but you get rid of some of that market and sector risk that's associated with holding a long only portfolio. And for those of you that don't know what that means, just bear with me and I'll explain everything when we get into this video. But before we do that, please make sure that you are subscribed to the channel. So if you haven't subscribed, hit the subscribe button and then hit the bell so that you get a notification as and when I release a new video. Okay? So what am I talking about when I'm talking about hedging out your portfolio? Is that even possible? Well, the concept that I'm about to show you isn't a new concept. It's something that has been around for a long time now, but most people use it in a slightly different way to the way that I use it. But for those of you that trade FX and have been trading FX with me, the concepts will be actually slightly familiar, because what we're going to be doing is we're going to be pairing strong stocks with weak stocks in a similar sort of way that we will pair a strong currency pair with a weak currency pair. So we're always looking to sort of like trade the strongest against the weakest. And you can apply that to the stock market and get yourself into a position where it doesn't matter what the S&P does. It doesn't matter what the Dow does or what the NASDAQ does or the FTSE or whatever stock market it is that you're trading in. It doesn't matter what the market does as a whole. As long as you've got your stock selection correct, then you'll be in a position where you can still make money. And sort of in the worst case scenario, then you're in a position where you don't lose as much money as you ordinarily could during a massive stock market crash. Okay? And what I'm referring to here is something called pairs trading. Okay, pairs trading is, as I said, something that's been around for donkey's years, so many tens and decades and decades and decades. But the way that people tend to use it is they use it as a sort of a reversion to the mean type strategy. So what they will do is they will find two very highly correlated stocks, and they will look for discrepancies in their trends. So they may look for a stock that has a big sell-off whilst the other one continues to appreciate in value, and then they will put together a trade that will take advantage of the fact that there will be a reversion to the mean. Okay, which isn't a problem at all. The only thing for me is that that's kind of more of an active and a short-term sort of trade, and I think that you need to be a little bit more talented in order to make money with that. The way that I do it is I look for, obviously I look to manage my stock portfolio, so I will look for stocks that I think are going to appreciate in value for the most part, unless we're in a recession or something like that, in which case I might look at shorting stocks. But for the most part, I'm looking at stocks that I can buy and I can hold for, a not considerable amount of time, but at least while the trend is there and while the momentum is in the markets. But what I don't like and what I don't feel comfortable with all of the time is being in a market where you're trading at extreme highs and there are some indications that perhaps the market is going to drop. There are some things going on in the world that sort of aren't really conducive to holding a long stock portfolio. So then what I want to do is I want to eliminate some of that risk, and I use pairs trading to do that. So as opposed to looking for discrepancy in the correlation between the pairs, what I would look to do instead is actually look for pairs that aren't correlated. So I would look for pairs that potentially in the same sector, the same industry and things like that, but they they have different outlooks. So I'll look for, I keep saying a pair, I would look for a stock that's particularly strong, and I think that it's going to appreciate in value. And if you're wondering how you can go about picking stocks, I'll make another video on that later, so don't worry about that. But you look for a stock where you believe that it's going to appreciate in value, and then you'll look for another stock that's in the same sort of sector or industry that you don't think is going to appreciate in value as much. And in fact, perhaps you think that it's going to drop in value. And what you do is you then combine those two stocks together to create what's known as a pairs trade, or some people refer to it as being a a ratio trade or a spread trade. There are various different terms for it. But ultimately, what you're doing is that you're buying two stocks simultaneously. You're buying one, not buying two simultaneously. You're buying one, you're selling the other, and you're getting yourself into a position where you're actually just trading one stock against the other rather than the entire market. Okay, and I know that some people will look at that and they'll say, well, you know what the problem is that then perhaps you'll be giving up some of your gains. Yes, in some cases you will, but at the same time you are protecting yourself. And in fact, you put yourself in a position where you can make money in a number of different situations. So if you had only bought the stock, then you could only make money if the stock went up, right? But in this case, where you're buying one stock and you're selling another, you can make money if one stock goes up. If the stock that you're buying goes up, you can make money if the stock that you're selling goes down. Okay, or you can make money if one goes up and the other goes down. The only way you're really going to lose money is if the stock that you're selling appreciates more than the one that you're buying. But if you get your stock selection correct, then you shouldn't be in that position too often. Now, I know I've been speaking a lot, so what we're going to do is let's jump over to the charts and I can kind of show you how this looks with some real stocks and show you how it's panned out over the recent crisis and how you would have been able to manage your portfolio. Okay, so we're now looking at a trading view screen, and on this trading view screen, I've got three different windows open. So I've got one up in the top left here, which is Microsoft. I've got IBM on the right-hand side, and then I've got the ratio, the pair, down here in the bottom. And if you're wondering how you get that, it's not like a currency pair where these actually exist. You have to sort of explicitly define them. So what you would do is you would come up into the top over here and you would type in MSFT/IBM, and that would then bring up the ratio of these two stocks right here, which essentially is what we're going to be trading. But I'll come back to that in a minute. What I want you to pay attention to first of all, though, is how these two different stocks, how they behave differently and their different characteristics and why you might want to put them together. I'm not going to go into, the whys and wherefores as to why you would have bought these specific ones, because I'm going to do another video to show you how you can go about selecting stocks later on. Right now, I just want you to understand the concept, okay? Now, let's assume that you took a view on Microsoft, all right? And let's say you took a view, well, you can take a view anywhere around here, but let's say you go all the way back to, 2017, that you thought that, they're going to appreciate in value. They're releasing new products. They had like the new Surface Pro, the Surface Book and all of that. So they had a lot of things going for them, and you thought they are going to appreciate in value over the next few years, and you wanted to add them to your stock portfolio. Fantastic. You add them, and as you can see here, there are a couple of swings, but that's absolutely normal. You get that with anything. But for the most part, the market does then just kind of go up, which is absolutely fine. You get a bit of a hairy moment here between October and December where the market just kind of keeps selling off, but then it recovers. And then it appreciates again, goes a little bit sideways, which is to be expected. All of that is to be expected. That's what you get, and that's not a problem at all. The problem comes when the markets drop sort of 25-30% in the space of a couple of weeks, and you get really scared and you look at selling your portfolio or you sell your holdings. And this is exactly what has recently happened. So you can see here that Microsoft went from a high of 190 down to a low of just above 130, so 132.19 there, from February 10th all the way down to March. So a little over 4 weeks, so about 6 weeks there, the market literally lost, or Microsoft lost 25% of its value, which obviously isn't a surprise. The whole market did that, but that's what I'm trying to show you in this video right here. So everything did that. So Microsoft isn't unique in this respect. I'm just trying to show you what happens when you're holding a stock long on its own and you're not mitigating that risk. And if you say, okay, well, I wouldn't have sold there, although most people probably, they inevitably sell at the low point, so then they kill them, well, they don't kill themselves, it's the wrong word, sorry, but they hate themselves when the market then obviously comes back and they see that, oh, actually the market did recover. The problem is that recovery process went from the 19th of March all the way up until around the 10th of June, which is when it broke the previous highs. So the high of the 10th of February, it then took another 4 months for it to break that high, which is fine if you go to sleep, you don't watch these market crashes, and you've got the kind of like the mental fortitude to be able to hold through this, but most people don't. Right, now let's take a look at IBM. So IBM weren't really setting the world alight at all. if we just look at it purely from a technical perspective, they were trending down. They certainly weren't, trending upwards or going anywhere, extremely fast. So you could have taken a view that, well, you're not expecting IBM to fall off the face of a cliff. They're an established company. They've been in the world for a long, long, long time now. You're not expecting them to, just disappear, but you're also not expecting them to appreciate as much as you were Microsoft. And this is kind of the thing here. You don't have to look for stocks that you think are going to sell off completely. You just need to look for stocks that you don't think are going to perform as well as the one that you want to go long. And then what happens is that if you put those together, so if we trade Microsoft against IBM, so we buy Microsoft and we sell IBM, then you get yourself into a position where you still benefit from the upwards move. So look at this uptrend over here. So we've got all of this. So where did we say we buy? 2016, 17. So the market moves up. It's got its normal swings. There's nothing we can do about swings. That's going to happen. The market continues to move up. Nice swinging movement to the upside. And then obviously we get the massive crisis that we've recently gone through. Hold on. Where is that crisis? February 10th. Let's go to February 10th. So what happened? Oh wow! So if we look at the ratio here, whilst we've got normal swings in the market, which is absolutely fine, when we get to that massive sell-off where Microsoft lost 25% of its value, and what did IBM do? They probably lost significantly more, 158 down to, so that was sort of just under around 40% of its value, maybe a little bit more right there. You can see that actually this ratio right here didn't do very much because you were trading them against each other, right? So yes, Microsoft lost some value, but IBM lost even more. So actually the market, it didn't even sort of like sneeze or anything. It just sort of went to the side. We got a little bit of sideways price action, and we didn't have to wait until June for it to go on to break new highs. No, 2 to 3 weeks later, the market then went on to break new highs. Okay, and that's really what I'm trying to demonstrate for you here, is that you don't need to give up your gains. Okay, you don't need to be in a position where just because you're selling the other stock that you're going to give up all of the gains that you would have got if you just traded one stock on its own. You actually just put yourself in a position where you can benefit from the upwards move. You can benefit from the downwards move of the stock that you're selling. But the biggest benefit to all of this is the fact that when a market crash does happen, you aren't in a position where you're losing 25, 30, 40% of your portfolio. Okay, so you don't have to get scared if it's your retirements or whatever it is that you're building towards. You've just sort of like wiped out 40% of your net worth overnight. No, you protected yourself. So now you're in a position where you can just kind of reassess the market. You might be in a position there where you think, you know what, I don't want to be in the market right now because there's so much uncertainty. Absolutely fine. But at least you don't need to sell your portfolio at a 25, 30% loss. You can just sell it around the highs where it is and just choose to get back in when the market breaks out to new highs. So there you have it. That's how you can manage your portfolio, and you can protect yourself against the market risk associated with holding a long only portfolio. I hope that all made sense to you, but if it doesn't, please feel free to post a comment beneath the video. If you're unsure about how you can go about selecting your stocks, I'm going to create a video on that as well. So stay tuned. In the next week or two, I'll put that up, and that will show you how you can kind of, now you understand the concepts of pairs trading, that will show you how you can go about selecting the various stocks that are going to make up your particular pair or the ratio or whatever it is that you want to refer to it as being, how you can put all of that together. Okay, if you didn't subscribe at the beginning, please subscribe now, hit the bell. Otherwise, thank you so much for watching this video, and I will catch you in the very next one. Take care now and have a fantastic day.